Hello, everybody. How you doing? Excuse me. Let's keep the camera from shaking. Decent number of people on here. I'm sure some people have no idea who I am. For those of you that have no idea who I am a nobody. I just manage my own money and sometimes make these YouTube videos. None of this is investment advice, and I'm just talking about my own opinion here. Invest at your own risk. Oh, Dan Hurley, USA. I wish I had known who you are. Only thing left to make this week any worse would be if Kid Dynamite's on right now. So let's talk MX. Oh, look at that. It's already rebounding. I think MX is an unbelievable opportunity situation right here. Though when I decided to do this YouTube, it was 21.50, not 22.50, but that doesn't matter. I was buying it at 25.50. I was buying it at 24. And then today I bought it at 21.50. So MX was down huge. It's still down big for an ARB. Because there was an article yesterday that came out, though it wasn't even today, it came out yesterday before the market opened, that the South Korean government is considering making OLED technology a critical technology for the state, which could put in place the potential for South Korea to block the MagnaChip sale to a Chinese private equity firm. So I probably should back up a second. For those of you that have no idea what the hell I'm talking about, MagnaChip, ticker MX, is a semiconductor company that's based in South Korea that got sold, announced to be sold to a Chinese private equity firm for $29 a share about 2 months ago. And it's trading at $22.40. So clearly people do not think that this deal is going to go through. People are concerned that a Chinese firm buying a South Korean semiconductor company, they might steal the secrets and put South Korean jobs out of place, out of work. What am I fucking saying? Anyway, you get the hint, get the idea. Basically, people are concerned that China is not going to be allowed to buy a South Korean company. So a lot's happened over the last few weeks with this name. It's basically just gone straight down as this kind of thing has been absorbed by the market. Though yesterday's article was the first time there was any kind of clear sense that they might go move to block it. What happens if they do declare this OLED technology a national security issue? It doesn't necessarily mean it gets blocked, though it's likely. That just means that they then have the power to review the deal. And then after they review the deal, if they decide that this company possesses something under that purview of national security, then nobody but a South Korean buyer could purchase them. So there's a lot to unpack here, okay? So first, let's talk about the history of the company and about the process that they went through to sell to the Chinese buyer. So MagnaChip used to be a larger company, and they sold their foundry business. I don't even know what foundry business is, but they sold their foundry business. I know nothing about semiconductors at all, by the way, nothing. That MagnaChip is basically a design company. So they design OLED technology, which is glass, I guess, for cars, for cell phones. Samsung's their biggest customer. And there's a huge growth potential with OLED technology in cell phones and cars over the next 5 to 10 years. That's pretty much all I know. So they sold their foundry business about a year ago, and that left them just with this design OLED business. And they have, after they sold the foundry business, they went from a net debt perspective to a net cash perspective. And they have about $657 a share in cash and no debt on the balance sheet. And they announced back in the fall that they were going to tell investors what they were going to do with their cash position. It was like in September when they closed on the foundry sale. They said that they would do an investor day in the fall, so like November of 2020. And they would announce what they would do with their capital position. November 2020 came around, and they said, "Oh, it's COVID. We're not going to announce it now. We'll do the investor day in the first quarter of 2021." Then February came, and they put out earnings, and they said, "We're not going to tell you what we're going to do with the cash today. We'll tell you in April when we do our investor day." Okay. And then a few weeks after that, there was an article that said that they were selling themselves, and there was a large auction happening, and it was largely Chinese and US buyers that were participating. And yeah, the stock was $19 and, it was basically in the 19s when that article came out. But if you look just a few days before that, it was 20, 21, 22. So if you want to anchor to a pre-deal price, you'd have to anchor somewhere in the 19s. Now you could argue what the market's done since then and what the semiconductor index has done since then, and somewhere, around down 5%, whatever, around that level. But, MagnaChip is nothing like a typical semi. I've never even noticed, I've owned it for about a year and a half. I've never even noticed it correlated with the SMH at all. I mean, there's no clear comp for MagnaChip in the entire stock market. So if you look at, I'm jumping all over the place, but if you look at the proxy and they list like 10 companies that are their comps, that's just what bankers do to justify a sale price. None of those companies are a clear comp. They either are growing much slower, they don't have the same end markets, they don't have the same margins. You can see the divergence between some of them trade at like 5 times EBITDA and some of them trade at 40 times EBITDA. Clearly, those aren't the same companies, right? Just by that fact, you could say that the comp list is ridiculous. But my point being with the history was that MagnaChip was always planning and will plan to distribute a large part of their cash on their balance sheet to shareholders if this deal breaks. Further, if Korea blocks this transaction, MagnaChip will get a $2 break fee, okay? And then on top of that, they will make over $1 earnings this year. So you put it all together, and you're looking at a stock that has about $10 in net cash, maybe $9.50 if you tax affect the breakup fee. I'm not even sure how much taxes they have to pay on that. And then no debt, and it's a $22 stock right now. Okay, I'm going to be jumping all over the place here, but I just want to show how extreme the margin of safety is here and all the different possibilities to win. So that's a $12 stock net of cash. And this year, sell side estimates, I think, are for them to make 90 cents. Let me pull it up. I have to pull it up because I don't believe any of the estimates, just so you understand. We could all pull up sell side estimates. I'm going to show you something that is interesting. Everybody click on this. So there's two things I want to talk to you about the sell side estimates. So first of all, as you can see, last year they made 73 cents during COVID. This year, the sell side expects them to make 89 cents for over 20% EPS growth. And next year, sell side expects them to make $1.12 for over 20% EPS growth. This is a fast growing company. Okay, they're growing the bottom line by double digits. The top line estimates for next year are an 8% growth, but the company says they plan on growing low double-digit revenues for the years to come. Okay, but this is not the important part to look at on this page. What's important to look at is the last 4 quarters of earnings history. Starting with June, you'll see they were supposed to make 7 cents, they made 13 cents. Then September, they were supposed to make 7 cents, they made 14 cents. In December, they're supposed to make 13 cents, they made 40 cents. And they just reported last week, supposed to make 14 cents, they made 22 cents. Okay, they've beat sell side numbers by 50 to 200% each of the last 4 quarters. Sell side numbers in general mean nothing. But I only want to point this out because the management guides, they didn't guide for the next quarter because of they're in a sale process, have a sale contract. But the sell side estimates are completely meaningless. They just take what management says and they model it. They don't deviate at all from what management's guidance is. So that 89 cents, that $1.12 are materially low, probably to the order of 50 to 80%. Really. So I think they're going to do probably closer to $1.25 this year, and they'll do north of $1.50 next year. And I mean, history will show you why I think this. Those numbers that they put up in those last 4 quarters were during COVID, and they have all this, inventory issues. So it's not a demand issue, it's a supply issue. It's different than the other things that are going on with semis, with automobiles and all this other stuff. This is a different kind of company. It's not being subject to the exact same market problems that are affecting what you hear about with worldwide semi shortages, but there is a supply issue for them. And as of February, they thought that by the end of March, they'd be back into a more normalized environment from a supply perspective. But anyway, these numbers are all stale. So you're paying $12 a share today for something that's growing 20+% bottom line and should grow top line low double digits. And it's not a traditionally cyclical company. Yeah, at some point, OLED will become a more mature, a more mature industry, but it's not going to be for years. Now you have risk that China catches up and they offer cheaper alternatives. And this is all reasons why South Korea is probably concerned about China buying them. So they steal the technology, then they undercut, South Korean business. I don't really want to talk too much about what happens in the worst case scenario, but that's the worst case scenario. The worst case scenario is this deal gets broken. There's no other buyer that can be acceptable to the South Korean government, and you're left with owning MagnaChip. Now, I own MagnaChip before this deal was announced. I do a lot of ARB, but I was a huge in MagnaChip before this deal was announced. So I clearly like MagnaChip, right? And of course, I don't really know anything about the semiconductor industry, but that's beside the point. I like the very unique nature of this company and how it's not in any indexes. It's a South Korean company listed on the New York Stock Exchange, and you have a pretty entrepreneurial CEO who has a few 100,000 options struck at 17 that expire in 2023. And he's never been a CEO of a company before, and I think this is very material to him. Which brings the question people ask all the time, why would he sell the company if he was excited about it? Well, he was going to run the company for the Chinese. They're keeping the same management team in place. So he will get very rich if this deal goes through. He'll make all of his money on a change of control, and all the options will vest at 29. And then they'll probably give him 5% of the company like you typically do for a management team and a private equity LBO. And that's way more than he has now. He owns like 1% of the company or less. So he's thrilled if this deal goes through, trust me. But there's two other possibilities here that the market is completely missing, okay? We'll talk about what the break is in a second, in the worst case scenario, which is that. But the other two options are the deal still gets approved at $29 a share versus $22 today. And mind you, it was trading in the 19s before, and we now get a $2 in cash breakup fee, and we get the entire year of earnings, which is about $1 or $1.25, okay? So it's trading at pro forma exactly where it was trading before there was ever a rumor for a sale. Now you could argue, oh, well, Matt, this means it can never be sold ever again. So, before when it was 19, it might have had some sale premium in it in the first place. Again, I don't know how you could argue that if they're going to do $1.50 in earnings next year on a $12 stock. Okay, you're not going to find any semiconductor company with this kind of growth profile that it would trade at 2 or 3 times this valuation. In fact, a guy that I follow and follows me, who actually sold all of his stock at 27 because he thought the deal was going to break, and he's looking like a genius right now, has done a bunch of videos on MagnaChip. You could find them on YouTube. And he was doing them from a fundamental perspective, and he thinks the stock's worth in the 40s. So he has very long videos about MagnaChip and about its technology. And you can find them on YouTube, and you should watch them. So anyway, so the government could decide to block it, or maybe they won't block it. Right? Maybe China exerts some influence and it goes through at 29. I don't know. Okay. That's definitely not my base case anymore, but the deal's not dead yet. And it's pricing in as being completely dead. Okay. Does that not mean that it can't, for a split second, if the deal breaks, go to 20 or 18 or 15? I don't know. I don't have that kind of, skill set. I can tell you that the way it traded today, and it kind of I call washing out in the low 21s, that to me traded like the market just priced in an effective break. And when you rinse out from ARBs to fundamental buyers, you're then going to see this opportunity for what the other two outcomes are. And the other two outcomes are really good outcomes. Okay. So first of all, there were 4 other bidders that were there the last day before the Chinese firm Wise Road decided to acquire, they signed the deal to acquire the company. 4 other bidders that did not walk away. And they were all there at the $25 plus price range. Some of them hadn't even given indication of a price yet. They just didn't have time to make an offer, potentially, okay? We don't know if those bidders were American or Chinese or possibly South Korean. They don't mention there. We know at least one of them was Chinese. Okay, it's obviously safe to assume that no Chinese buyer will be able to buy them if Wise Road can't buy them. It's also safe to assume that no American will be able to buy them if the Chinese can't buy them, for 2 reasons. One, South Korea decides this is a national security issue. They're not going to let Americans buy it. And then if the South Koreans block a Chinese buyer, the Chinese are probably gonna be pissed, and the Chinese might block an American buyer. Okay, but no one's gonna block a South Korean buyer from a South Korean company. Okay, there's whether it's strategic or it's a financial, they will be able to get that through. We have no idea if there's a South Korean buyer in there. There could have been a South Korean buyer in there at 26 or 27 or 28, whatever. Okay. It is not unheard of to think that right now the company is trying to find a white knight buyer and someone that will pay $29.50 and clean up this whole mess for the South Korean government so they don't have to block it and piss off China at the same time. Okay. It's definitely not unheard of. There were multiple other bidders there the week before this was over. And go read the proxy, you'll see it. So I don't even put that as like a 5% chance. I would say there is a 20% chance this deal goes through as is. There's a 30% chance they find an alternative solution, alternative bidder. And there's a 50% chance the deal breaks. So in the 20% chance the deal goes through, you get 29. In the 30% chance there's an alternative solution, you get who knows what price, 27 to 35. I don't know. And then in the 50% chance the deal breaks, what happens then? Well, I've talked about this in the previous video, but there's very interesting language on the last MagnaChip conference call. And I would like to read it to all of you. Now, mind you, they were in the middle of a process during this conference call. And they had many bidders, and they probably knew they were going to end up with a sale. And the same thing in November. The process had already begun in November. That was the reason why, of course, they pushed off the announcement about what they were going to do with the cash. This is what they said on February 17th, which is weeks before they sold themselves. I'll copy and paste it. It won't let me copy paste it. So I'll just read it. Our board is committed to maximizing shareholder value and is evaluating various options, including a holistic review of our capital allocation strategy, our target liquidity position, and our ongoing distribution framework. We recognize that the company may currently have excess liquidity. We plan to address, among other things, a comprehensive plan for our near-term capital allocation, our liquidity, leverage policy, and our ongoing shareholder distribution on or before the upcoming Analyst Day. The words leverage policy are very interesting to me because I have never known a company to refer to a leverage policy unless they planned on taking on debt. That's what leverage is. So to me, I think the company is going to be in a real tight spot. If the deal gets blocked and they don't have a backup deal, they are going to have to create shareholder value for shareholders, obviously, and they're not going to have a lot of time to do it. And the easiest way for them to do it is, of course, doing something with their balance sheet. Now, I believe that they will not only pay out all of their cash. Again, I'm basing this on nothing. The company's never told me this. The company has never guided to what they think their net cash or net debt position should be. But I do want to remind you that they had hundreds of millions of dollars of debt before they sold their foundry business. And the company is obviously comfortable with having a debt position. And now their financials have never been stronger. They never grew like they're going to grow in the next few years in 2017, 2018, 2019. And they had hundreds of millions of dollars of debt on the balance sheet. So I believe it's not unheard of that they take out 1 to 2 times leverage and they add that to their $10 in net cash, and they either do a tender offer or they to provide liquidity for all the shareholders that want it out in a buyout, or they just pay a large one-time dividend. And either or, you're going to be left with a stub stock, right? Where instead of it being $22.20, it's going to be somewhere between $10 and $15, depending on whether they pay $12 dividend, a $5 dividend, a $7 dividend, whatever. And you're going to have $1.50 in earnings of next year, which, by the way, will be same year because this deal won't break in the coming weeks. It'll probably be closer to the summer or the fall if it breaks, unless you get a white knight bidder, which could happen at any time, though it probably can't happen legally after a shareholder vote. If the shareholder vote for this deal is 4 weeks from now, if the shareholder vote happens and they haven't found a white knight bidder, they have to wait until the deal's actually formally blocked by South Korea before they get the breakup fee, and then they can take a new bidder. It's in the company's interest, quite frankly, to have the deal blocked by South Korea. They'll get $2 a share in cash. If there's a white knight bidder, they have to pay a breakup fee of, I don't know, 75 cents or something. So, $2 to them versus paying 75 cents. The company might just decide, we'll wait until we get the breakup fee, then look for that South Korean bidder after, right? So that the 275 swing there. I don't know the correct way that they're gonna, in what order or what time frame. But what I do know is I have a $22 stock right now that is absurdly cheap based on any metric you look at, right? And that is very rare for a risk arb deal, where you have upside to deal completion, huge upside to deal completion here. You have potential overbid upside if they can get one of those other 4 bidders that's not Chinese, and potentially if an American bidder came in right now and overbid, potentially the South Korean government has told MAGNACHIP that they would back away from the critical technology language, right? We have no idea what's going on behind the scenes. Samsung is probably in control of all this, and Samsung is probably just telling them what is and is not acceptable to them. So, you can't come up with a hairier situation, right? A South Korean company that ARBs are looking at South Korean newspapers every morning and translating, and then trading it, crazy based on whatever the daily press release is. So that's basically my whole spiel. I would like to take questions now. Let's see what we got. Foundry is the part of the business that builds the physical chips from semi-wafers. Chip companies go fabless without foundry and outsource that to a more specialized player like TMC. Yeah, Pravin. I mean, I do realize that's the general idea, that it's much more of a national security issue, the foundry plants versus the technology or the design. I'm told that this is not a very complicated business, and it's not even a national security issue. So that's neither here nor there. If South Korea wants to make it a national security issue for politics, then they're going to make it a national security issue. They haven't yet, right? That's just what the market is now fully pricing in. Has anything been announced about the break? No, the company has not said a single word about this breaking up, or that it's going to break, or that they're getting an indication of breaking. This is all happening based on newspaper articles and ARBs talking to experts. But there's been no actual indication about it breaking. Any early lunch thoughts? I'm making a chicken salad. I made chicken last night on the grill, and I always make a lot of it. And then I'm going to cut it up, and I'm going to put it in a salad, and I'm going to put salad dressing on it and make that for my whole family. Why did the stock rally from 12 in December to 20 pre-announcements? A possible deal was behind that and the true deal price. It's a good question. It was really cheap at $12. I know that sounds ridiculous, but at $12, there was $7 or $6 then, $6 a share in net cash, and they were going to do over $1 earnings this year. So it's definitely possible there was some leakage. It's not going back to $12. There's $10 in net cash and no debt after this deal breaks, and they'll do $1.50 in earnings next year. So I wouldn't anchor on the $12. I mean, plenty of stocks are really cheap at some point in their life history. Look at any stock in the last year that's gone up 500 or 700%. No pizza left over. I do have some pizza left over, but I'm not a big leftover pizza guy. I like my leftover food that I cook a lot the next day, but I don't like leftovers from restaurants the next day. Why doesn't Samsung just buy them? Samsung's just one of their customers. And if Samsung bought them, then all their other customers wouldn't want to work with them because Samsung's a competitor to the other customers, is my guess. I don't think Samsung needs this. They're like, the most important to understand is they're just a pimple. MAGNACHIP is a small little company, right? 500 million of revenue, whatever it is, and $1.5 billion enterprise value. And this is not some giant semiconductor company that the world revolves on. It's easy to think that because China's so interested in getting this technology and all these people want to buy it, which is another point I want to bring up. If you have 5 to 10 bidders all wanting to buy this company, and they're not all strategic and they're not all financial, they're both, doesn't that mean that MagnaChip's pretty interesting? They must be doing something right, and they must have a future in the next few years. So that's not something to me that you trade at 10 times, earnings. If you have all of these interests in it, this wasn't like some hard sale. They had a competitive auction with 4 people still waiting to buy them at the end of the auction, right? It's a 20 times business, maybe even a 25 times business, net of cash. Is this like a recap that's talked about in Greenblatt's book? What? I don't understand. You mean like a spinoff? Or I don't know idea what. Greenblatt does not talk about MagnaChip in his special sit book. Who is the analyst who issued many videos on fundies you mentioned? I can find that for you. Hold on. I'll show you his name. One second. I'll tweet his name, and you can find a link to his videos. I'll tweet a link to his videos. Let me find him. I mean, I give this guy a lot of credit. He sold this whole position the one day it bounced, the day that they put out the 8K. That's just one of his videos, but it's a lot of videos. He talks about recapitalization, which is a scenario you described may happen with MagnaChip. Yeah, I mean, okay. I don't expect there to be a huge amount. I mean, look, I'd be pretty surprised if they took out debt to pay a dividend. Okay. My base case is not them taking out debt to pay a dividend. My base case is they pay at least a $5 dividend. No less than $5, which would be half of their cash in their balance sheet. Why did Citi issue 24.50 price target? I have no idea. I don't think the sell side has any idea what they're doing here. Usually after a company is in a sale, they don't even follow it anymore because they think it's over. And like I said, all of the sell side just follows what management guides to. And, all the numbers are stale. And management sandbags every quarter. So it is pretty interesting. Management didn't guide the next quarter because they're in the sale process. So who knows what they put up in the second quarter. It could be very different than what the sell side's at. It could be below it. It could be way above it because there's no guidance. And sell side usually has their hand held. My buddy says that the semi shortages are actually helping their mix and is giving a huge boost to their margins. That's why their gross margin beat happened last quarter and why it should happen in the future. He also told me I look beautiful on here. Do you think MX CEO kicking himself for taking highest offer and not factoring political situation? I actually give them a lot of credit, Jake. So if you read the proxy, and you guys all should read the proxy, they spent most of their time worried about the breakup fee, not just the highest price. And they got a very big breakup fee here, right? $2 a share is a big breakup fee if Korea blocks. So maybe they did look at behind the scenes what they thought was most likely to be accepted, but really they wanted to make sure they were protected. So let's talk a little about that. So what's the worst thing that happens here? The worst thing that happens here is there's no deal. They run their business like they've always run their business this year, and they get $2. And yes, Wall Street says, okay, I guess this company can never be sold to anyone but a South Korean buyer. But that, if I was management, that's what I would think, right? I wouldn't be so worried about the downside break because I get $2 I didn't have before and I move on. So you see in this delayed action on DDS, and any thoughts on why good things like this never happen to us? I saw Dillard's yesterday. How much is it up today? 18%. Oh, it's actually fading a little bit. Dude, that number, the Dillard's number yesterday was unbelievable. I don't follow department stores, and I'm a firm believer that they're dinosaurs. Dillard's was supposed to make like $2 in earnings last quarter. It made $6 if you take out the one-time gain on real estate. Supposed to make $2, made $6 in a quarter. It was $100 stock. Unbelievable. Any idea who is selling? Fundamental guys. No, this is ARBs selling here. These are ARBs punting and punting and punting. These are not fundamental guys. Yeah. ARBs are not in this for, round 2 and round 3. ARBs bought this to make $29 a share. And now that they think it's not likely to make $29 a share, they have no interest in doing any of the math, that I did. I've had a few ARBs tell me that the break price is 1950 minus 10% because the semiconductor index has gone down 10% from 1950. I mean, it's all ridiculous. Okay. Could it go to 1950 for a hot second? It could. I would bet anybody it doesn't. I would actually bet anybody that it will not even touch 1950 for a minute. Because the math's the math. I mean, in 1950, it's $10 again of cash. That's just facts. Not somewhere between 950 and 10. And then it would be a $9 stock making $1.50 next year, growing at 20+%. Okay. There's no stock like that in the stock market. If they take out debt to pay a dividend, then would it be fixed or floating rate? No way smart value investor takes out floating rate debt to pay dividend at this point in the cycle. Yeah, Rich, I would think they would take out fixed interest rate, fixed debt. They could easily borrow money at very low rates if they're only taking out 1 turn or 1.5 turns of leverage. So maybe they would have just a credit line, pay out most of their cash and have a credit line. So in case they need it in the case of a down cycle, I don't know. Why would you talk about why you usually go long using call spreads? Is it because you get to capture the profitability of selling way out of the money calls while being long and use a little margin? I do call spreads for a few different reasons. I talked about it in my last video. First reason is I like that it tells me the exact amount of money I have to put up, and it's an exact risk reward on the trade. So for instance, I did it with MagnaChip. So I'm long. I did this before the deal happened. I'm long a huge amount of September 2250, 25 MagnaChip call spreads. I wouldn't put them on today, but I'm long them. I paid 70 cents for them. So for me, I put up 70 cents to make $1.70. And that was my fixed, cost benefit. Pay 70, make $1.70. The stock was like 19 or 20 or 21. And I put it on in January and February. And all I had to do was have it go to 320 for break even and 25 for max. And I believed that I didn't even think they were going to sell themselves. I believed that after they announced the dividend plan in April and they put up the good numbers throughout the year, you would get above $25 a share. I believed it pretty strongly, which is pretty funny because that's basically my point here, right? I was betting, this is a great point that I'm making because I make some great fucking points. I was betting on this stock to be above $25 before they ever had an article about them being for sale. So this isn't me like doing Monday morning, reverse, thesis because I happen to be long it. I believe this stock was going to be materially higher from here before all of this. And now I get the optionality of a deal going through at 29 and I get the optionality of another bidder coming in that I never had before. So that's the first reason why I do call spreads. Fixed amount of money, capture the amount that I want. The second reason is I don't usually like to bet that a stock's going to go up a huge amount of money. So I'm not the kind of investor that invests in, kind of very risky, growthy stocks. So I don't expect stocks to go up 3, 4, 5x from where I buy them. Usually the kind of companies I buy, I think are going to double. So I thought Dell would probably double. I thought MagnaChip would probably double. Groupon, I thought the margin of safety from when I started buying it in the high teens, even in the low 20s would double. Groupon, I think has a case to me where it can go up, into the hundreds if they get their business model right, but that's not my base case scenario. So with all of these scenarios, if I think they could double and not go up 4 or 5x, and they have expensive calls, The only way that it makes more sense for me to buy calls versus buy call spreads is if I think it's going to gap up 100% one day in a sale, or it's going to go up hundreds of percent based on, whatever, crushing it in earnings or what have you. I don't usually think that in any of my names. So with Groupon, when I put on call spreads, I was getting like 5-1, 6-1, 7-1, 8-1. And all I needed the stock to do was go up 50% or 70% or 60%, right? If I bought the calls there, I would need to have the stock go up 100 to 150% to have the same return as the 50 or 60% I would have needed for the call spread. Now, there's a lot of detriments to call spreads. Once it goes above your strike on the short call side, you needed to expire there, of course, to get your maximum value. Many times the stock might go back down and you didn't make your money, right? I only put on call spreads when I want to own the stock and the company, and I believe in the long-term thesis of it. If I'm just playing like a binary biotech and I expect them to have a good phase 3 or something, and I buy 6-month or year-out call spreads, it might not work. It might go up 100% on the phase 3 data and then fade it all the way back over the next 6 months, right? And I can't sell it. I mean, I could sell the call spread for much less than it's worth before it expires, but I'm not going to get the maximum amount. And the final reason why I like call spreads is that intuitively, when a stock goes higher, I want to be smaller in it. So if I own a Groupon, 40 or 50, 60 call spread, and Groupon goes to 60, and then 65, then 70, then 75, I'm naturally having less exposure in Groupon in that call spread because it's going to approach that 50, 60 call spread is going to approach full value of $10 the higher Groupon goes and the closer we get to expiration of the call spread. And that means my exposure is going down. And then guess what? When Groupon goes down from 70, 60, 50, my exposure goes up. And I'm okay with that because I really like Groupon. So it's just a natural way to sell as it goes up and to get bigger as it goes down. It also does help with margin sometimes. If I have a non-marginable security and if I put on a call spread, I can be bigger in it than if I just buy the stock. Now, when shouldn't you use call spreads? When don't I like to use call spreads? The worst time I think to use call spreads is when you don't believe there's a lot of downside in a stock. MagnaChip's a pretty good example here, right? I don't think MagnaChip is an example where I would want to use options right now. And I'm not using options right now because I don't want to have to pay for the premium in the implied put when you buy a call. So let's say right now you could buy September 20 MagnaChip calls or Jan 2021, 20 calls. And you think, well, they're trading at whatever, I don't even know what they're trading at, $4, or I'm just guessing. And if it goes to 29, I get $9. So 4 to 9, it's a great return. And it's true, that is a great return. But I don't think this is ever going below 20. So for me, my risk right now is $2.40. Not $22.40, but $2.40. Now, yes, there could be a huge stock market correction. A lot of things could happen. And you shouldn't bank on it not going below 20. But for me, that's where I'm at right now with this. So I don't need leverage. I don't want more leverage by making MagnaChip huge via calls. If I could just buy more common. And I'm comfortable buying more common, going on margin. I use a significant amount of margin for things like this and for SPACs and what have you. And that's just how I invest. If you're not comfortable investing that way, you shouldn't go on margin. And yeah, you can use calls instead of buying common. And it's not a terrible way to play it, but that's just not how I invest. Groupon really pissed me off this week, by the way. I like how IWM has recovered all of its losses the last 2 days, and Groupon hasn't gotten back to 49. Just a shitty week, a shitty week. I'd also like to say that Groupon had no Form 4 sales yesterday. You would have had it by now if there was any sales or trades after the quarter. And the CEO is still interim. We're on like month 15 now. TikTok, what's going on in Groupon? Why not synthetic long versus stock? Synthetic long is in buy a call, sell a put. they're going to charge me the same margin on that. That won't change my margin. And I'm only borrowing at 75 basis points. So I don't have any reason to do that. And you're going to pay much more in option commissions than you pay in stock commissions. And you're not going to get as tight of a stock spread as you would if you bought stock. So it's going to cost you a slippage by putting the synthetic on. Synthetic, by the way, everybody, is you'd buy the 20 call and you'd sell the 20 put. And it creates MagnaChip at $22.27 if you do that. You mostly put on a synthetic when it's hard to borrow and you want to capture the borrow fees. So you can usually buy it at cheaper than what it's trading at if you bought it synthetically. Other than that, I'd have no reason to buy it synthetically. My wife just texted me, I think I threw away my Barclays card yesterday. That's our credit card. Great. Like I said, this week just keeps on giving. Any other questions? So to sum up, can this go lower? Yes. Can this deal break? Yes. There's no guarantees, but there's panic. There's blood in the streets, everybody. That's what this is. Blood in the streets. And today was the day. Today was the day where the real panic kicked in. So I'm happy it finally happened. And yeah, I wouldn't even be surprised if it closes green today, quite frankly, because it's too cheap. And people could do math. It just takes time to go from the ARB investor to the fundamental investor. Do I ever sell call spreads before expiry? That's a great question, Max. Usually no, but I look at it. So if it got really full, if it came really close to my full call spread, my full price, and I thought that the risk reward of the incremental, squeezing the last amount out wasn't there, I might consider doing it. If it gets really close to OpX and it's close to the strike price of the upper end of the band, I'll do it. And finally, I'll do it when sometimes I put on call spreads that are leaps, and I'll have to sell that before expiry to get long-term capital gains. Because if you let it expire in the money, it exercises it and it's short-term capital gains. So I'll sell the whole call spread in the open market for a few pennies less than what it's worth to get long-term capital gains. Or sell the long or cover the short. I don't usually do that, Max. I don't usually do one side or the other. But it starts getting tricky around OpX. If I have a really big call spread and it's trading close to the short end of the spread, or it's trading close to the long end of the spread, I will sell out the long end and stay short the short end if I have stock to cover it in case it goes up huge on a buyout or something. I do that often. I don't just let the short end expire. Sorry, the long end expire and risk all the theta losses in the weeks before. So to give you an example, if right now Groupon, if I was long Groupon 45 June calls, if I had a Groupon 45, 55 call spread, and let's say OpX was next week, I would start selling out Groupon 45 calls probably Monday and sell it out Monday, Tuesday, Wednesday, Thursday, and Friday. So that by Friday, I'm out of the Groupon 45 calls and I'd be short the 55 calls against my position in case there was a buyout that week. I wouldn't wait until the end of the week and do it all that day. And I wouldn't exercise them and do it all that Monday. Usually. I can't believe the fucking thing's below 47 now. Just the worst week ever. Any other questions? Thanks for the big turnout. Let's hope next week's better than this week. Everybody have a great weekend. Bye.